So hi, Peter Jones, Chartered Surveyor, author and property investor, and in this short series of videos we're thinking about property and taxation. And in the last video we were looking at the old days and what the best way was to set up our property business in terms of tax. Now by the old days I mean up until 2015, because it was in 2015 that the then Chancellor, George Osborne, came up with this idea that he was not going to allow investors stroke landlords who bought properties in their own names to offset mortgage interest when calculating the profit that they were making from their buy-to-let properties for the purposes of calculating their income tax. So at that moment the whole tax landscape changed, and the received wisdom became that whereas before buy-to-lets should be in one's own name, because then if you ever needed to sell you could take advantage of capital gains tax allowances, if you were buying buy-to-lets, you should now buy them into a limited company. Now, if you remember back to the last video, we were saying that it was also considered that the best way to buy properties for trading, in other words flipping, was to buy those into a limited company, and I gave the reasons for that in the last video. So now we end up with a situation where basically it doesn't matter which strategy you're following, you want to be in a limited company. Now of course there's exceptions to that. It may be that your own personal circumstances mean it's not that much of an issue. So for example, this is really only going to affect, in theory, higher rate taxpayers. If you're a lower rate taxpayer, you may be okay. Having said that though, you need to talk to your accountant, because it could be that the mere fact that you own a property, even if at the moment you're in a lower tax rate, that having the property and having the changes to the way that mortgage interest is used or offset could push you into the higher tax bracket, so you need to check. But for most of us, probably the best way forward now is to do everything through a limited company. So the big advantage of using a limited company is that at the moment, as things stand, and this could change in a future budget, but as things stand, we can offset all of our mortgage interest against rents when calculating corporation tax. So that's great. And it's not just mortgage interest, by the way, but it's any interest on a business loan can be offset against the profits of the company when calculating corporation tax. So that's a big plus, especially as corporation tax is relatively low, as we said in the last video. It's currently 19% and probably going down to 17%. All depends on who's in government at the time. But there are disadvantages to this as well, because all of the money that you have within your limited company is within the limited company. So whereas before, if it was in your name you could get your hands on the money, sorry to put it so crudely, but that's kind of what we're concerned about if we're in business, you could do that. With a limited company it's not quite so straightforward, because the money actually belongs to the company and the company is a separate entity to you. So there's really only 2 or 3 ways that you can actually get money out of a limited company. The first is by taking dividends, the second is by paying yourself a salary, and the third is by taking a loan. So let's take those in reverse order. Can you make a loan from the company to you? Well, yes you can, but your company would have to charge you a commercial rate of interest, and you've got to pay it back at some point. You can't just take the money and say, you know what, I don't think I'll bother paying this loan back. You've got to pay it back at some point, otherwise HMRC are going to cry foul. Can you pay yourself a salary? Well, yes, of course you can. The difficulty with paying yourself a salary, though, is that you're going to be charged income tax. So at that point, when you take money out of your limited company, you will pay tax on that. Unfortunately, there's no other way around that. And what about dividends? Well, yes, there are ways of taking dividends out of a company, but the amount that the government are allowing us to take out of a limited company by way of dividends is reducing. It's going from £5,000 down to £3,000. But, and here's the big kicker on this, the thing is you can only take a dividend if the company is making a profit. Now you might say, well, what's the problem with that, Peter? Surely we want our companies to make a profit. But do we? Because when you think about it, when you think about all the costs involved in refurbing a property, for example, and doing all the repairs and all this kind of stuff, it's highly likely, if not probable, that at some point your limited company is going to make a loss. And maybe actually for tax purposes that's quite a healthy thing, because then you won't even be paying corporation tax. But if that is the case, then you won't be able to pay yourself a dividend, which means that you'll only be able to pay yourself PAYE and you'll be charged income tax. Now the benefit of making a tax loss is that the tax loss in the company can be carried forward. So if you do make a profit in future years, or if you, for example, if you want to sell your properties and you make a nice capital gain on those properties, capital gain within a limited company is going to be charged at corporation tax. There isn't a separate tax for whether it's rental income or whether it's a capital gain from sales. It all comes under corporation tax. So if you've made a loss because you've repaired your properties, for example, and if that loss has been enhanced by it because you've taken a salary, because obviously your salary is a cost to the business, so that would reduce the profit of the company, and then you sell your properties in the future, then the capital that you release as profit may even be tax-free, depending upon what your losses are carried forward and how much you sell the properties for and how much of that is actually a profit. So everything has an upside and a downside, everything has a pro and a con, and this is why I said in the very first video there's probably no ideal solution, but we have to roll with what we've got. And at the moment the landscape, the tax landscape has changed, and for most of us, subject to my usual proviso, you need to talk to your accountant because it might not be true for you, but for most of us, buying into a limited company, whether it's for buy-to-let or whether it's for buying and selling on, is going to be the best way forward. So until next time, here's to successful property investing.